Amos 3:3 asks, "Do two walk together unless they have agreed to meet?" Hi, I'm Rob West. In context, that verse speaks to Israel's relationship with God, but it also reminds us of a simple truth that applies to marriage. Two people can't walk together unless they're headed in the same direction. Today, my friend Matt Bell joins us to help couples think about money in ways that strengthen unity rather than create division. And then we'll take your calls at 800-525-7000. That's 800-525-7000. This is Faith and Finance, biblical wisdom for your financial journey. Well, it's always a pleasure to welcome Matt Bell back to the program. Matt is the managing editor at Sound Mind Investing, one of our valued underwriters, and he has a brand new book out with focus on the family called Starting Strong, Discovering the Good That Money Can Do in Your Marriage. We're excited to talk about it today. Matt, great to have you back, and congrats on the new book.
Thanks so much, Rob. It's really great to be back with you.
Let's begin, Matt, with what many couples experience firsthand. Why does money so often become a source of division in marriage when God designed it to be an opportunity for unity?
Yeah, a lot of it can be attributed to the fact that couples don't enter marriage as blank slates. We all bring money-related stuff into our marriage, and that's often very different stuff. Different financial circumstances, backgrounds, experiences, hopes, dreams, fears, how we saw our parents deal with money. That's a really big one. Temperaments and more. And it's easy for all those differences to just collide with each other, which can happen in the form of day-to-day money management habits that differ. One's a spender, one's a saver. And especially sometimes when there are really big financial decisions to be made. One wants to stretch and buy as much house as possible, for example, or one wants to play it more conservatively. And of course, these things can be resolved, but it often takes time and patience and some intentional conversations.
Yeah, that's well said, Matt. In Starting Strong, you say that one of the first steps for couples is to cast a shared vision. Talk about what that looks like practically in everyday life.
Yeah, that's right, Rob. Because all the differences we just talked about, it's helpful to find common ground. And I encourage couples to look for that common ground in their shared faith. So the new book opens with several recommended prayers that are all about committing together through prayer that they'll seek in all things, including money, to serve the Lord, to base their decisions on the solid rock of God's Word, to agree that everything belongs to God and they're stewards of all that He's entrusted to them, and to seek unity in their marriage through their financial decision-making. I know it's really big picture stuff, but it's essential to start there because that'll get the marriage headed in the right general direction.
Yeah. One of the clear questions that comes up time and time again on this program that couples have to wrestle with is whether to combine their finances or keep their accounts separate. How do you encourage couples to think through that decision?
Yeah, I strongly recommend joint accounts. Now, as you know, there are some accounts that you can't combine, like IRAs, which, after all, are individual retirement accounts. But for all the accounts that you can combine, like checking accounts and savings accounts, I strongly recommend joint accounts because they foster transparency and teamwork. They prevent secrecy from happening. And I'll tell you, Rob, there was a really interesting study on this topic. It was done at Indiana University, a secular school. And their researchers found that when couples combine their finances, it reduces financial fights and increases overall marital happiness. But there was also one really interesting, surprising finding from the study, and that is that couples who combine their finances, they're more likely to do things for their spouse without expecting reciprocity.
Huh.
Yeah, it was surprising. I mean, the lead researcher was asked about that because it did stand out from some of the kind of more predictable findings from the study. And she said that when couples combine finances, they tend to have more of what she called a communal relationship. And that's where partners respond to each other's needs simply because there's a need. They have more of a we perspective about their marriage rather than a that's yours and this is mine perspective, which impacts all areas of their relationship.
That's helpful. Matt, if somebody is not on the same page with their spouse, they'd like to have everything shared. One spouse just feels like that's a recipe for disaster. How would you encourage that spouse to lean into that conversation?
Yeah, I think it starts back to those big picture prayers, looking into Scripture, looking into God's Word to see what does the Bible teach us about what our marriage is to be about. And I think that if they really earnestly do that work and pray together about that, they will see that marriage is designed, God's vision for marriage is oneness, it's unity, and combining finances is a step that'll really help foster that.
We're talking with Matt Bell today. His new book out with focus on the family is called Starting Strong, Discovering the Good That Money Can Do in Your Marriage. More on that straight ahead. Stick around. By shifting from a yours and mine mentality to a unified ours, couples can turn money from a source of division into an opportunity for greater unity in marriage. We're talking about money and marriage today with my friend Matt Bell. Matt is the managing editor at Sound Mind Investing, a valued underwriter of this program. His brand new book out with focus on the family is called Starting Strong, Discovering the Good That Money Can Do in Your Marriage. And Matt, we've talked about several key ideas, including the joining together of money in marriage and how that's such an important idea. Another is really around communication. You encourage couples to have regular money meetings. So let's get practical for a moment. How often should those happen, and what should couples make sure to cover?
Yeah, it's a great question. So initially, I recommend that couples spend as much time as it takes to develop a cash flow plan aligned with their commitments and goals. That can take some time initially and probably multiple conversations. But once it's up and running, I would carve out then 60 minutes at the end of each month to look at how things went and what might need to change going forward. Over time, those meetings will take less time. But here's an important point. This isn't just about an end of the month conversation. It's about an ongoing communication. And once you have a cash flow plan established, it's important for both spouses to manage to the numbers in the plan. I like that phrase, manage to the numbers.
Yes.
That means not waiting until the end of the month to see what happened, but actively using their cash flow plan to make things happen, to spend money intentionally. So, for example, before you go to the grocery store or a clothing store, you're checking to see how you're doing in your clothing or grocery budgets this month. And that information is guiding your decisions in those stores so that you're managing money intentionally. That way you won't get to the end of the month and be completely surprised at how things went.
Yeah, that's so helpful. And I think having that regular rhythm is really key. Now, debt can almost feel like an unwelcome third party in a marriage, Matt. How can couples face that both honestly, but also work through it together?
It's a really, really big factor. One researcher that I read his work, he said that debt is a cancer on marriage. It can create just a lot of stress. And couples with debt, as they enter their marriage, they tend to spend less time together. I don't know if that's because they're working extra jobs or what that is, but it's just a real negative factor in marriage. So if a couple is starting their marriage with any debt other than a reasonable mortgage, I strongly, strongly encourage them to make it a high priority to get out from under that debt sooner than later. Even if that means putting off buying a house, even if that means spending less on vacations or cars or whatever else than your friends are spending. If a couple gets out of debt early in their marriage and stays out of debt other than a reasonable mortgage, that will be so incredibly good for their marriage.
I couldn't agree more. Now, a moment ago, you mentioned a cash flow plan and the importance of it. And you make the point that it's really not about restriction, but direction. I'd love for you to talk about that a bit.
Sure. So a lot of people think of a budget as being about less, less spending, less freedom, less fun. But a budget, or as you said, I prefer to call it a cash flow plan, is actually about more. It's about having more knowledge about what's happening with your finances so you can be more intentional in managing those resources. So you end up having more for the things that really matter to you. So if people listening to this have never used a cash flow plan before, you may have to take that on faith. It'll take a little getting used to, but
Sure.
soon enough, you'll wonder how you ever lived without it.
Yeah, that's right. I love that you focus an entire chapter on generosity. Let's talk about giving and how that can really help to foster unity and bring the couple closer together.
Sure. So giving changes the focus from us to God and from us to others. The Bible says that where our treasure is, there our heart will be also. So, in that sense, giving is a tool of discipleship. When we give to God to further his kingdom work, that just orients our hearts ever more toward him. And there's such joy in
Yeah.
living generously. As a minister, I know likes to say when something amazing, something miraculous happens through our church or another ministry that we support, we didn't cause that to happen, but we got to be a part of that. And there was such great joy in that.
Yeah. Perhaps we can bring that to life through a story, Matt. Can you share a real life story of a couple who really practiced what you just described and how that then affected their marriage?
Absolutely. One of my favorite couples that I've ever interviewed for any of the writing I've done is Scott and Karen. When they got married, Karen brought $50,000 of non-mortgage debt into their marriage. And Scott had a great sense of humor about it. He called it a reverse dowry, which I love.
I love that.
But from their very first days as husband and wife, they were truly in it together. Karen would often express regret about what she kept calling my debt. My debt is keeping us from doing this or that. But Scott, from the earliest days, would correct her and say, it's our debt. I just love that they were truly in it together. So
Yeah.
they were committed to getting out of debt together. And at the same time, they felt compelled to live generously despite that debt. So as they kept sending these big checks to creditors each month, they also gave at least 10% of their income. And I love this. The phrase they used at that time was 10% of net until we're out of debt. And then they changed it to 10% of gross.
Oh, that's great.
So they were just very convicted, very just motivated to honor God with the first fruits, with the first portion of all that he blessed them with, no matter what. It took them a long time to get out of debt, about 7 years. And during that time, there were many days when they wished that they had the resources to buy a home, but they were committed to getting out of debt and committed to living generously. And when they finally got out of debt, when they looked back, they could clearly see God's purposes for all that happened. Karen said it took that time for God to mold her heart and to change some of her attitudes about money. And as they looked back in a real practical sense, they saw that if they had been able to buy a house on their schedule, it would have been at what turned out to be a peak in the housing market.
Oh, wow. Well, I can hear even in that story that they really are taking a team approach. I mean, even though it's not something fun to think about, it sounds like it was really kind of a tongue-in-cheek, approach that they had, which really, I think, just gives a picture of the unity that they were driving toward. Is that right?
Absolutely. And I think it fostered that unity. It just bound them together in this shared mission to get out of debt. Scott wasn't blaming Karen for the debt. He wasn't upset about the debt. I mean, sure, he'd rather enter marriage without debt, but he loved her and
Yes.
wanted to make sure that she didn't feel guilty about the debt she brought into it, wanted to make her feel and see very clearly that they were in this thing together.
That's a beautiful picture. Matt, we have just about a minute left. For somebody listening right now that just feels stuck, where would they go next?
Yeah, I would find time when emotions are under control. Usually there's a particular issue. Oftentimes it's debt. And so find a time when emotions are low and they can truly listen to each other. Deal in facts, not assumptions. I find that often couples are having disagreements when they're not really dealing with the facts, which is why having a cash flow plan is so helpful. Pray together for sure. Keep
Yes.
God at the center of their marriage and their marriage relationship valued much more important than their financial situations. And if they need help, I mean, there are many churches that have stewardship ministries that would love to come alongside them to encourage them and help them in practical ways with financial coaches. And they may even want to avail themselves of a marriage counselor. But through it all, keep that big picture in mind. Keep your focus on honoring God with your finances and keeping your marriage strong.
Matt, this has been so helpful and encouraging. So thankful for you, my friend. Thanks for stopping by today.
It's my pleasure, Rob.
That's Matt Bell, managing editor at Sound Mind Investing. All right, folks, you got to go get it. The book is called Starting Strong, Discovering the Good That Money Can Do in Your Marriage. Buy it wherever you buy books. And check out soundmindinvesting.org as well. Sound Mind Investing has been a longtime partner and underwriter of ours here at Faith and Finance. Your calls are next. 800-525-7000. That's 800-525-7000. This is Faith and Finance, biblical wisdom for your financial journey. We'll be right back.
The opinions offered during this program represent the personal or professional opinions of the participants, given for informational purposes only. Any information provided is not intended to replace advice from a financial, medical, legal, or other professional who understands your specific situation.
Great to have you with us today on Faith and Finance Live. I'm Rob West. Well, the lines are open. It's time for your phone calls today at 800-525-7000. Joshua, Martha, Gwendolyn, Artie in the queue. We've got room for you, though, so call right now, 800-525-7000 with any financial questions today. We'd love to tackle them. Let's dive in. By the way, great to have Matt Bell here, and just so appreciate Matt's insights. Pick up a copy of that book, brand new from Focus on the Family. You know, my friend Shanti Feldhahn, the Harvard researcher, along with her husband Jeff, they did a study years ago on this whole area of money and marriage. They wrote a book on their findings called Thriving in Love and Money. But they found that really three things were key to moving forward in marriage around money and making that a healthy relationship. And they parallel so well with what Matt just said. But number one was communication. I know you're not surprised. Everything kind of rises and falls on communication in marriage. But it was key that you got to talk about it. That's why Howard Dayton, the former host of this program, often talked of a money date once a month coming together. Matt said spend an hour once a month. Not finger pointing. We're course correcting. What worked, what didn't work, where are we headed, what can we do to support that? That's really key. Second, understanding. Remember, Matt said we bring not a blank slate into the marriage, we bring differences in temperament and how mom and dad handled money or the lack thereof and what was modeled to us. You know, the way you handle money today, scientists tell us, was largely in place by the age of 9. Now, when you understand how your spouse is wired and what they're bringing to the table, you can come together and actually be a more accurate reflection of Christ. You know, it's not as good to be all spend or all save. Really, that healthy tension, if it's healthy, is a good thing to finding God's heart in how you live as a faithful steward. So communication, understanding, but then the third, and this was surprising, it wasn't a matter of the amount of income these couples had that had a healthy relationship on money and marriage. It was that whatever that income was, they were living below it. So the key was margin, or what you might call surplus. And really those couples that had something left over at the end of the month, it was stark, the difference in how often those couples with margin, alongside communication and understanding, had that healthy relationship with money, far more so than those living right up to the edge or beyond it. So think about that. Those could be some areas that you can work on. Certainly I can, but we can work together on those in our marriages. All right. Let's turn the corner. We're going to open it up to any financial question today at 800-525-7000. Let's begin in Chicagoland. WMBI. Joshua, go ahead.
Hi. Thanks so much for taking the call. I'm interested in your opinion about these advertisements that are, I've found mine on social media, right? But they're enticing people with loans with their homes with, I've got a 3% APR on $300,000, and the value of the home is probably double that or so. But they're saying that we should convert to simple interest loans. And so whether that's something that we could do with our current loan or when we move in a few years, should we explore a simple interest loan as opposed to an APR? I'm kind of in the dark, and I'm looking on your approval or disapproval about such things.
Yeah, it's a great question. The advertising can be misleading. I mean, simple interest mortgages do exist, but they're not a magic way to save money. The math is different, but the real question is whether you'll actually pay less over time after considering the interest rate and the fees. So here's how the math works. A traditional fixed rate mortgage, the interest is calculated as a part of the monthly amortization schedule. Early payments are mostly interest early in the period, the payback period, or the total term of the loan are mostly interest because the loan balance is the highest. And then as principal declines, more of each payment goes toward principal. With a simple interest mortgage, interest accrues daily on the outstanding balance. So each day your charge is principal times interest rate divided by 365. And then when you make a payment, it first covers the interest that is accrued since your last payment, and then the rest reduces the principal. Now, here's why people say you save money. If you pay early each month or make extra principal payments, then the principal balance drops sooner, and because interest is calculated daily, you pay slightly less interest going forward. But here's the important point. You can achieve much of the same benefit with a traditional mortgage by making extra payments, and that's why I'm skeptical of the marketing. When can it make sense? Well, if someone gets paid weekly or biweekly and makes frequent payments or regularly pays extra toward the principal and you have a competitive interest rate and low fees, possibly. When it doesn't make sense is when you're refinancing from a 3% mortgage to a 6% simple interest. You'll almost certainly lose money despite the quote simple interest label. Now, in your case, we're talking about buying a new home. Is that right?
That's the potential. In a few years, we're thinking maybe about hopping across the border into Wisconsin where things are cheaper and cost of living is lower. So when we make that move, if we make that move with a simple interest loan, would that make sense for us?
Yeah, so then you're not giving up an existing low-rate mortgage. If it's a brand new one, it's reasonable to compare it, but I still wouldn't choose one simply because it's called simple interest. I'd choose the one with the lowest overall cost. And with the 30-year fixed, your monthly payment is fixed. The loan is amortized over 30 years. With the simple interest, again, it accrues daily. If you pay on time every month, the difference in total interest compared with a comparable conventional loan is often modest. So again, it's really going to come down to, are you going to pay bi-weekly? Are you going to make extra principal payments regularly? Those are the cases where it could make sense, but I would still ask, what's the interest rate? What's the APR? Are there higher fees and closing costs? And make sure you get to the bottom of what it's actually going to benefit you. I hope that helps. We'll be right back. Great to have you with us today on Faith and Finance Live. I'm Rob West. We're taking your calls and questions today. We've got room for you. Some lines open. If you've got a question, call right now, 800-525-7000. Let's go down to Florida. Martha, how can I help?
Hi. Thank you for having me on, and I really appreciate your show. I've learned a lot listening over the years.
Well, thank you, Martha.
My question is, I inherited land in 2003 from my parents' trust. I sold some over the years, but I've sold the last of it in 2025. I've been late on filing my taxes, which is costing me, but I'm working on it with an accountant. Apparently the tax the accountant has come up with is a lot more than I thought I would owe. I was thinking that with my donations and the amount that is not included because of an inheritance would cut the taxes way down, but it's still quite a bit. So I wanted to know, does the inheritance waiver apply to the amount after I sell it, after I inherited it? I know there's capital gains tax based on the price it was when I got it and what it is now. But does the inheritance waiver help me at all now?
Yeah. So have you already sold this property?
Yes.
Okay. So it was inherited in 2003, sold in 2025.
Yeah.
And you're talking about an inheritance disclaimer or what's sometimes called an inheritance waiver. Is that right?
Well, I know that there's something like a cap of $1 million on what you can inherit without having to pay tax. But does that only apply to the land itself when I inherited it, or does it apply to what I got when I sold it 23 years later?
Yeah. So because you inherited this back in 2003, I mean, there's a misconception around, if you inherit more than a certain amount, you automatically owe tax. That's not how it works. There is no federal inheritance tax. there's a federal estate tax that's due with estates of a certain size. I mean, for 2026, that's estates larger than $15 million. But inherited real estate is not taxable to the person inheriting it, and it does receive that step up in basis. So if you later sell it, which you've done, you owe the capital gains tax only on the appreciation after the date of death. So that would be, what you would have going on here, where you'd verify the cost basis, and that basically is what the value was in 2003, and then you'd include all the selling costs and any capital improvements, and then if the property was sold, you would have ultimately whatever that gain is that would be subject to capital gains tax.
Be about 15%.
Yeah, I mean, what is the total gain that you realized for your portion?
Well, it started out being appraised at around $10,000 an acre, and it has come up to one piece sold for $24 an acre, and the other sold for $30 an acre. And there were about 24 acres altogether.
Okay, but do you know what the total capital gain is that you realized?
You mean the sale price?
Sale price minus the cost basis.
I haven't done that yet. The accountant's working on that.
Yeah, so for 2025, if that's the year you sold it, last year, the long-term capital gains rates were 0, 15, and 20%. Do you file as a single person?
Oh, yes.
Single?
Yep.
Okay. Yeah. So, if you have a total capital gain plus your ordinary income, your taxable income, the total of those two together, if it's between 90 or 48,000 and 533,000, which is where most people would fall, because again, it's the capital gain plus your income, then it's 15% on the gain.
So that's a reasonable amount what I'm paying then. I should have planned better.
Yeah, I'm sorry. I know. Yeah. So have you already spent that money or allocated it somewhere?
Well, I have some allocated for that, but I thought my donations giving 10%, over the years, and that year would cover it somehow, I thought. But I should have paid 15% instead of 10% donations.
Yeah. Donations made in the year of the capital gain, could affect your total taxable income, assuming you itemize, but it's not a direct offset. If you make donations in the same year of a large capital gain, it can be effective, but again, it's going to reduce your overall tax bill by reducing your taxable income in that year, which is not a direct offset for the capital gain itself. So those two things, are unrelated. Now, if you gave enough such that you reduced your taxable income to offset the gain, well, that may work, but you would just have to get with your CPA and see what kind of impact your contribution is going to make on your taxable income and whether you're going to owe more than you've set aside in the first place.
Okay. It's a hard pill to swallow, but the Lord will take care of it, right?
He will, and there are options here. You can connect or have your CPA connect with the IRS and work on a payment plan or something like that. This does come up regularly, and the IRS is ready for it, and they're probably more accommodating than people give them credit for with these kinds of things. And so just know you're not going to have to write that check all at once, and if you can't, there are other ways to approach it. So thanks for your call today, Martha. All the best to you. Illinois is where we're headed next. Gwendolyn, how can I help?
Hi, I have two questions. I'm interested in knowing if there's a product you can recommend that would combine both life insurance and long-term care benefit. And also, would this product, can it be combined with an investment aspect, or would you have to buy a separate product for an investment along with an insurance?
Yeah. Great question. And, having a hybrid policy can be an effective solution. It's not the right fit for everyone. Basically, you've got three approaches. You've got a traditional long-term care insurance policy, which is specifically for long-term care. And if you ever need care, you'll receive the benefit as long as you qualify based on a certain number of what's called activities of daily living that you cannot function or perform. And then the second option is life insurance with a long-term care rider, which is what you're talking about. That's a hybrid policy. So if you need the long-term care, you get part of the death benefit to help pay for those expenses. And if you never need it, your beneficiaries receive the life insurance death benefit. So, this addresses the concern of use it or lose it. And then there's, other types of asset-based policies as well if you're not going to self-fund. And ultimately, it comes down to your overall health and insurability and whether you have enough assets to self-insure. But the hybrid policy can be a very effective tool as long as you need the true life insurance alongside it. Let's do this. I'm up against a break. I'll give you some other thoughts and address the investment component right up to the break. Stay with us. Thanks for joining us today on Faith and Finance Live. Here in our final segment, we'll get to as many calls as we can. Before the break, we were talking to Gwendolyn in Illinois. She's wondering about long-term care insurance combined with life insurance, and then separately, whether there's such a thing that includes both of those plus an investment. Let's go back to when you'd want straight long-term care insurance or versus a hybrid policy, life insurance plus a long-term care insurance rider. And keep in mind, before we even get to that, 70% of Americans 65 and older will need long-term care for some period of time, usually 2 to 3 years. And full nursing care is expensive. It can run $100,000 a year or more. And so if there's a risk, an unknown risk that you want to mitigate in this season of life that could erode your assets, the need for expensive and ongoing long-term care is probably up near the top of the list, if not at the top of the list. But these policies are expensive. They have increases, and a lot of people just struggle to pay for them. And a lot of people struggle with the use it or lose it, meaning, wait a minute, if I pay all this money in and I never need it, I don't get anything for it. Well, that's right. Kind of like your car insurance if you don't have a wreck, or your term life insurance if you don't pass away, you're offsetting the risk. Now, who would be best suited for a traditional kind of straight long-term care insurance product? Well, that'd be somebody whose primary concern is paying for the future long-term care expenses they may have, and you want the most long-term care coverage per premium dollar because you're not adding any other features in, and you have sufficient retirement assets. But typically, this is someone who wants to protect them from the high cost of extended care, meaning, we can reasonably see how we can fund our lifestyle for the rest of our lives based on what we've saved. But we know there is this chance that if we needed extended care and it was expensive, that could be a problem. And so therefore, we're going to add this long-term care insurance policy. It's less ideal if you don't like the idea that you may never use the policy and therefore the money is quote unquote lost, or you have difficulty qualifying medically. Now, who would want a hybrid life insurance plus long-term care? Well, that's the person that says, I don't want to pay premiums and get nothing back if I don't need care. Those who have need for permanent life insurance, who is that? Well, that'd be a parent of a child with special needs that needs lifelong financial support, a business owner who needs funding for a buy-sell agreement, people with significant estates, a lifelong dependent, high-income earners who've already maximized other tax advantage savings like 401ks or IRAs. Otherwise, most people don't need permanent life insurance. That's why we recommend generally that you just buy term insurance while you're working, save in your 401k, and then you drop the insurance when you get to retirement. And again, if you have sufficient retirement assets, but you're worried about expensive long-term care, you'd add a straight long-term care insurance policy at that point. All right, now the final piece, Gwendolyn, was what about an investment component? Yes, some permanent life insurance policies like Index Universal Life, IULs, and Variable Universal Life, VULs, can accumulate cash value and could have a long-term care insurance rider. However, I generally don't recommend buying life insurance as an investment. Now, I've thrown a lot at you there. Is that helpful?
Wow. Yes. So you don't recommend the index. People go with that idea, index universal life, because it's something sitting there that's earning, but can be used if need be.
Yes.
And then paid back into if there's a need to borrow against it.
Yeah. I mean, a lot of people will say that's the benefit is you got the permanent life insurance if it's properly funded, the tax deferred cash value growth, you've got the downside protection, and you can access through policy loans if it's structured properly, tax-free access to cash. But they're complex, they're expensive, the growth is capped, which is where most of the long-term annualized growth of an investment portfolio comes in the strong up years, but you don't get that in these products because you have to give that to the insurance company once you get above the cap. If the policy is underfunded because rising insurance costs later in life reduce the cash value or cause it to lapse. So there's just a lot of qualifiers there. And at the end of the day, I just find that for most people, it's not the best solution.
Oh, okay.
Yeah.
So just continue to invest in an IRA or a Roth IRA or traditional IRA and by term. And then once you get to be 65, though, your term insurance starts to increase with every ring of age.
But you don't need it at that point because you've got the retirement assets. So therefore, there is no risk because no one's depending upon you for your income at that point. So that insurance is no longer necessary. It's kind of like if you sold your car, you wouldn't need car insurance. Well, if you stop working, you don't need insurance to cover the risk of the loss of income. And at that point, your only risk is, or a risk is, the primary one is the need for extended long-term care. And again, if you can afford it, that's where a long-term care insurance policy can be helpful. So, hey, we're going to have a long-term care insurance expert who's a Christ follower. He's a leader in the industry nationwide on here in the next few weeks. Be sure to listen to that broadcast. But hopefully this has given you a few things to think about, Gwendolyn. Thanks for your call today. Let's go to Florida. Richard, go ahead.
Yeah, I just want to know your thoughts regarding somebody who has equity in the home and maybe they're thinking about getting a home equity line of credit. I've seen some new products called home equity arrangements versus a home equity line of credit.
Yeah, I don't like the HEA. It's a home equity agreement. And the reason is you lose your home's future appreciation. So, with an HEA, if your home appreciates significantly, you're giving up a share of that appreciation, which can become much more expensive than paying interest on a loan. And the contracts are complex, so it's important to understand what you're getting yourself into and how the payoff is calculated. So, neither is inherently good or bad. They're different tools, but I would just far prefer, the home equity line of credit, which is for someone who has good credit, sufficient income to qualify, and you have short to medium term borrowing needs. And I like them most often for home improvements, certainly not lifestyle spending. But, the benefit is it's secured by your home. You retain 100% ownership of your home's future appreciation. So if your home value rises, which historically homes have risen in value consistently, all of that increase belongs to you.
Perfect. All right. Appreciate it.
Absolutely. Thanks for your call today. Lord bless you. Let's see. We've got, time for one more call. Let's go to Georgia. Anna, how can I help? Anna, are you with us?
Yes, I am. So sorry.
All right. Turn down that radio for me and then we'll go right ahead.
It took me a minute to answer.
No problem.
My husband and I are about to give up so that a full-time nursing student for 1 year. And because of the way that we have lived, we just haven't spent. And so we've managed over the course of our marriage on salaries of about $30,000 to save up. And so we are looking towards this coming year because I got into my dream school. It will be an accelerated program, and we will be paying full tuition because it's out of state. and living off of our savings for the year.
Yes. All right. Is your husband working?
No. Well, we homestead. So basically what we do is he works our land so that we can live off of our dairy, meat, and garden and not spend. So his job is kind of eliminating our expenses.
Yeah. And then how are you going to handle the schooling being out of state?
Well, it's the only reason it's out of state is because it's we're kind of on the border, so we don't have another one close to us.
I see. Okay.
So it's not like far away.
Yeah, very good. Well, I love this. I mean, congratulations. You got into your dream school. Your husband obviously is a hard worker, wants you to be able to pursue your dream. That's amazing. And I love that you're thinking about this now before you just kind of go full head first into this new opportunity. It can be a wonderful investment in your future, but you want to make sure you're not creating a financial crisis in the process. So, really it comes down to what will it cost to live for the next year? And I love the fact that your expenses are minimal because of what your husband is doing to produce, for you all to live off of the land there that you have. The second would be how much cash do you have available? And then ultimately, what is your backup plan if school takes longer or an unexpected expense comes up, things like that. So just given what you know about your lifestyle and your expenses and your savings, kind of where would that leave you after you finish school? Would you have exhausted your savings? Would you be able to still have some emergency savings, or where would you be?
We think that we will still have savings. It'll be about $38,000, and from what we're looking at now, we haven't used. We've saved each year that I've worked, so we don't seem to be using up my full $28,000 salary each year, and so we would probably still have approximately $40,000.
Okay, so once you graduate, you'd still have $40,000 in the bank based on your calculations?
The best I can just off the cuff.
Okay, yeah. Well, I mean, I think that's the key. As long as you run the numbers, you know what it's going to cost you both for your lifestyle spending plus your college tuition, to get the degree, and any other costs. And as long as you just don't squeeze yourself too much financially, I'm on board with this. What a gift and a blessing that you and your husband can do this together. Hey, Anna, thanks for your call. Unfortunately, I'm out of time today. Faith and Finance Live is a partnership between Moody Radio and Faith Fi. Come back and join us tomorrow. We'll see you then. Bye-bye.